just had the latest FOMC meeting. We got a pause in the interest rate, but there was a hidden detail which markets are not happy with. Will this lead the market to tumble to the downside? Jerome Powell just delivered his press conference. Didn't shake the market too much, but what is worrying the markets is the summary of economic projections. We're going to break that down and a lot more. Smash all the likes. Don't forget to subscribe if you want to support this channel. You can trade using Bybit, ijaz.uk/Bybit. Link is in the description. Guys, check this out. So we got the 0% basis point rate hike, right? So a pause. We got that as expected. Markets were a little bit fearful that maybe he'd surprise us with a full-on rugging and give 25 basis points. He didn't do that, but he rugged in a different way. I need to break down exactly what just happened. Now remember, not every FOMC meeting has a summary of economic projections. If you watch my preview video from earlier today, you would have known exactly what to expect because we called it perfectly, guys. If you don't watch the videos, you got to stay subscribed with the bell notification on because no other crypto channel is giving you this content. The only reason I know this stuff is I used to work in TradFi, right? So anybody who's pretending to know this stuff, they weren't in TradFi. They're only doing it because covering an FOMC meeting is fun. We've been doing this for 2 years. So if you look here, guys, the Fed funds rate here, they kept it at 5.6. We're sitting at 5.25 to 5.5. In other words, what Jerome Powell just did by not changing that number is he's basically kept that extra rate hike in his back pocket. So we've got 2 more rate hikes now before the end of the year. November the 1st and December the 13th. 2 more FOMC meetings, sorry. He can now probably decide to go for 1 more hike in either of those meetings. And even in his press conference, he kind of alluded to the fact that that's where we're at. So unless inflation really does start to come tumbling down to the downside, I think they will use that option to go ahead with 1 more rate hike. You can see 32% of the market here is pricing in that November will deliver 25 basis points, and you can see here that the market is pretty much expecting that we're going to get 1 in either of these meetings, okay? So they kept that optionality. The next thing you will notice, which is the critical bit which upset the markets, crazily, is this. They revised the Fed funds rate projection for the end of 2024, so next year. They revised it from 4.6 in the last June projection to 5.1. What does that mean? What that basically means is they have taken off 50 basis points worth of rate cuts from next year. Now remember, markets were looking forward to next year. They were looking forward to a year where Bitcoin halving happens and plus we see the Fed fund rate tumbling down to the downside. But they've just taken half of that away. They're saying we're going to go from this 5.6% range down to 5.1. So you're only going to see 50 basis points of cuts next year. In other words, we're going to stay higher for longer and keep rates higher than we previously thought, for longer than we previously thought. And if you look at it, they also revised the 2025 figure, right? They popped that 50 basis points on there as well. They said instead of going down to 3.4, we'll be at 3.9. And so if you look at it with the cold light of day, you start wondering, okay, we could be at the end of 2025 and still be at 4% or close to 3.9% Fed funds rate. That's quite painful if you think about it, right? Because this illusion that we were just going to tumble down quickly once the Fed are done is starting to make markets realize, hang on, we could be here for quite long. And if you look at the end of 2026, you could be sitting at 2.9%. Okay, so that's quite painful. And then, when you start to then look at stuff, what you can then see is that they revised the GDP. So the GDP in the June projection said 1%. That got revised up to 2.1% and 1.5% from 1.1 in 2024. In other words, the economy is doing much better than we thought. Inflation was, unemployment, revised down from 4.1 to 3.8. They just can't create the unemployment to bring inflation down. Labor market is too strong. Demand is outstripping supply. And so we sit here and we walk down to the dot plots, and this is where you start to see the story unfold. You start to see that about 4 more members wanted 1 more rate hike than those that didn't. So slight edge to the ones that want to do 1 more rate hike, and that's evident here. And also, this is where you start to see the division about what's going to happen in 2024. You can see here the majority in 2024 sit in pretty much this cluster here, right? To say, okay, we'll get down to 4.75 to about the 5.5 range, somewhere between there. Now, of course, when you take a look at the median, that is where we're getting that 5.1 figure, which I highlighted to you earlier. This is what's going to upset the markets. Now, Jerome Powell came out not too crazy hawkish, so he didn't rug us too much, which is good, but this summary of economic projections would have rugged markets. He's just taken 50 basis points of rate cuts away from next year, which ruined the party that markets were looking forward to next year. So if we take a look at what happened while he was speaking, dollar index is now rallying, right? Broke its previous peak and started moving to the upside. You can see Bitcoin falling to the downside, now lower than when the initial rate decision and meeting originally occurred. Same for the NASDAQ QQQ, same for the S&P. Government 2-year bonds have gone through the roof, okay? Because remember, if the Fed funds rate are going to stay higher, 2-year yield can be higher. So in other words, you can get 5.1% just parking your money in a safe, risk-free government bond. Therefore, why would you be in Bitcoin? Why would you be in the S&P? Why would you be in the NASDAQ? The 2-year government yield is at the lowest we have seen since 2006. In other words, there has never been, since 2006, a greater reason to not be invested in growth stocks or crypto. And this is what now provides the challenge for us in crypto right now, is that we have no catalyst to rotate risk back on. We know the last 10 weeks have been hugely painful here, with the dollar index propelling itself here with 10 consecutive big candlesticks. And Jerome Powell's meeting today and his press conference have only indicated that risk could be off for a little bit longer. So it looks like this EMA ribbon will complete its flippening. Don't be surprised to see dollar index try to go mount another attack further up the curve here, and that could spell some more pain ahead for Bitcoin. So that's what I'm preparing for here in this current market. Look, it was a little bit of a rug pull in terms of the S&P, in terms of the SEP, the Summary of Economic Projections, but overall markets were expecting that pause. The problem now is the market will have to scurry quickly to price in one more rate hike before the end of the year, plus unwind 50 basis points of cuts, which they had priced in for next year. So that's where we're at here in this market, guys. If you appreciate this type of content, do smash up the likes. Don't forget to subscribe. Also, don't forget that Bitcoin here is struggling on the weekly candle, trying its best to close this weekly candle above its EMA ribbon. But with that news, it's going to prove difficult. What catalyst can now come out to deliver us a pump here in the rest of this week? We've got 4 days until this weekly candle closes. Can we close above it, right? We need to be at about 27.3, 27.4 on the weekly close to reclaim the weekly candle. On the daily candles, you can see the same thing happening, right? We're getting rejected here intraday, and it looks like we're just about to close below the EMA ribbon today, and that won't be great. We've got 4 hours to try to push this back up and get back above the EMA ribbon. Then we can reclaim our daily EMA ribbon. If we're unable to do so, it looks like we're just going to get rejected, just like we have done previously from the EMA ribbon, which could spell some more pain ahead. The real question we now need to ask ourselves is, if rates are going to stay tighter for longer, if we're going to be in this situation where the Fed does not want to loosen going into next year when we get the Bitcoin halving, what is going to propel our next bull run? And my view is it's going to be that institutional money. It's going to be the need for the spot ETF to get approved, allow BlackRock, allow Fidelity, allow ARK Investment, and many others to come into the market, maybe even get a Ethereum futures ETF approved as well, and that could propel us, give the excitement back to the market, and then retail can follow through too, because the reality is this crypto market has retraced from 3 trillion in the market, locked and loaded at the peak, to now sitting at 1 trillion. And the question is, what's going to bring that money back into the market, right? When monetary policy is tight, when we've got 5% rates and people are struggling to pay their mortgages, struggling to pay their car finance, this is a very different situation to when Bitcoin hit 69,000. Stimulus checks were flying about, interest rates were virtually zero. We were in a very, very loose position. Now we've just had the tightest rate hiking cycle we've seen in a very long time, and it looks like Jerome Powell wants to stay there for longer. The question is going to be, will Jerome Powell break something? Will we suddenly get a flash crash recession? He's hoping we'll still get a soft landing. And will he be forced to trigger immediate emergency rate cuts to loosen his policy? We've got loads to watch out for over the next few months. Make sure you subscribe with the notification bell on. If you appreciate the content, likes, subscribe, and I'll see you in the next one.